Let's do it. Good morning. Welcome to the Street Today here from Post 35 on the floor of the New York Stock Exchange. That is not a green screen behind me. It is real. Today is Tuesday, the 31st of January, the last day of the first month of the year, somehow and possibly. I'm JD Durkin. That's what the box in the corner says, so I guess that's my name. We're about an hour or so into the trading session. Stocks are in mixed territory as investors look to close out January in the green. Been a pretty solid month overall across the major market indexes. A few hiccups last week. Obviously, earnings season rolls along. We got the jobs number on Friday. We got the Fed decision tomorrow. Weeks like this, I think the news needs to be kind of spread out a little bit because for those of us on this side of things, we don't sleep very often and we drink far too much caffeine. Let's take a look for what is on tap for this morning's broadcast. We'll preview, can you tell I'm already underslept? We'll preview tech earnings of some of the biggest names like Meta, that's the artist formerly known as Facebook, Apple, Amazon, Alphabet, all prepared to release their quarterly results. Plus, we will talk, yes, the Fed, as the central bank's two-day FOMC meeting kicks off today and ends tomorrow. And finally, we will dig into BP's outlook as the energy giant predicts waning oil and gas demand. For more on those stories and so much more, we bring in our special guest this morning, Chris Konstantinos, is Chief Investment Strategist, Director of Investments at RiverFront Investment Group. Chris, good morning. I'm sorry that I nearly got your intro wrong.
Oh, it doesn't matter. Those titles, titles are free. It doesn't matter what you call me.
Listen, I am a perfectionist. I like to get everything right. Thank you for being here to help us understand what is going on. Let's start big picture here today, my friend. Stocks slated to close out January in green, even as we look up at the big board today, and we try and see how the dust will settle for today's session. What do you think drove all the optimism to kick off the first trading month of 2023?
Yeah, I think there's really two catalysts here at work for the rally we've seen in January. The first thing is just simply the massive amount of investor pessimism that marked much of 22. And this is something we can talk about it anecdotally, but this is also something that we track here at RiverFront. We've built some processes through the years to try to quantify investor sentiment or crowd sentiment. What we were tracking through December is that investor sentiment, really through the latter half of 22, was incredibly pessimistic, arguably at a pessimistic crescendo, if you will, and had been for months. So I think you entered the year with everybody being super pessimistic, which from a contrarian perspective can help cause, at the very least, a counter trend rally. And then on top of that, and maybe more importantly, is that we've seen the body language of the Fed, I think, evolve a little bit in a slightly less aggressive fashion, right? We've seen some recent leaks from the Federal Reserve's preferred leaker at the Wall Street Journal around, the idea that they're thinking about maybe pausing in the second half of this year and just, waiting to see how inflation shapes up since it's come down some. And I think markets are laser focused on Federal Reserve rhetoric because at the end of the day, the interest rates and money supply are really, in my opinion, what drives markets in the short to intermediate term. So I think those two catalysts together kind of set us up for a strong January.
We'll get to touch on the Fed in a bit more detail coming up, but an old theory says as January goes, so goes the rest of the year. But of course, we're not dealing with we are dealing with a very unique series of cross currents right now. We have no idea how the year is going to go. Any reason for a bit of optimism on your end to think that we will continue to see stocks keep up the bit of momentum we've had?
Sure. And I wouldn't place my optimism around those types of, historical anecdotes. We like to call that financial entertainment. Interesting, but not necessarily actionable. The reason I do think there is some optimism for the whole of 23 is when you go back and you look at the carnage we had in 22, and I'm not just talking about stocks. Actually, more specifically, I'm talking about the bond market. Stocks had a pretty bad draw. There's probably been, 10 or 15, 25% drawdown since the 1960s in the stock market. But when you look at what happened in the government bond market, in the treasury market, that's arguably the worst treasury market we've seen maybe, in 60 or 70 years. And both of those, most investors I talk to are balanced investors. They're not just all stock investors. They own stocks and bonds. So when you put that together, that was a terrible historical draw. And when you look at the historical outcomes going forward, historically speaking, when you've gotten draws and balanced portfolios that bad, usually the next 2 to 3 years looks pretty good. So I think that's reason number one for optimism. You have history on your side a little bit there as it relates to returns for this year. The second thing is, and this is maybe less obvious, is when we went back and studied some of the historical analogs to what we're seeing today with the inflation regime and interest rates, et cetera, one of the periods that sticks out to us is the period of between the late 60s and the early 1980s, where there was roughly 4 recessions. And we studied the corporate earnings stream during those periods. And it's probably surprised a lot of your viewers to learn the corporate earnings stream throughout that period actually didn't do all that badly. Even during those recessions, they actually, corporate earnings in the US hung in a lot better than they did in, say, 2008 or, the tech wreck in 2000. And part of the reason for that is that nominal economic growth, before taking inflation into account, was actually positive for that entire period of the late 60s to early 80s. Whereas nominal GDP growth went negative in, say, 2008 during the credit crisis. So if we're in for an analog, of what we saw in the 70s with inflation structurally higher, that bit of inflation can actually, help boost, in constant terms, revenue. And so we think that corporate earnings in the U.S. may be a little bit more resilient than people expect. And that, in my mind, could be a mild positive for 23.
Markets today, of course, are already eagerly looking forward to Friday jobs numbers. Any reason to think here the job market will continue to remain as hot as we had last month, or is it time for a bit of a pullback? We know where Chairman Powell would like to see the numbers go, but actually getting them there has proved a bit more difficult, I think.
Yeah. So, first of all, I believe in the message of markets. I think there is information and trends. And as you rightfully point out, the trend in the job market it's ultra hot and is likely to stay that way for the foreseeable future. Also, I think we have a bit of a bifurcation happening, right? We like to chop up the jobs market and look at it by, different strata, different earnings strata. And what we're seeing, even though you've seen in the news, you've seen tons of very, very high profile layoffs, at various tech companies and consumer facing companies, et cetera. But at the lower end, the lower strata of earners, there's still many more jobs needed than job seekers. I think the stats are still something like 1.5, 1.7 jobs out there for everyone looking for a job. And that's really happening at the low end. So I expect wages at the low end to be really, really strong. I expect payrolls at the low end to be really, really strong. And where we're seeing the softening is at the top of the market. So you put it all together, there's still, fewer extremely high wage earners in the U.S. than there are low to medium size wage earners. So therefore, I expect the payrolls number to continue to be quite strong.
And again, I'm sure we'll hit on that when we kind of zero in on the Fed here in just a few moments. To this point about GDP, last year was a kind of strange picture, right? I mean, we had a lot of accusations thrown around. Okay, well, clearly we're in a recession. We had the first 2 quarters of contraction, and then that was not the case for the third quarter. That was not the case for the fourth quarter. And I wonder what your expectation here is as we wrap up the first month of the first quarter for 2023. Or is it possible that this year really won't end up being as bad as some are predicting through the lens of GDP?
Yeah, that's a great question. So our base case scenario, or our highest probability scenario that we published in our Outlook back in December, was for positive real GDP growth for the whole of 2023, but not dramatically positive. I think it's somewhere slightly north of 1%. So pretty moribund, but still positive, but not necessarily recessionary. We think that, a recession, if it's going to happen in this country, is likely to really manifest itself towards the end of 23, maybe even into the early part of 24. And we expect that recession, when and if it comes, to be relatively mild compared to what we witnessed again in 2008 or certainly in 2020, when our economy had a full stop shutdown. Like in a month, 10% of our entire economic output disappeared during the pandemic shutdown. So, I'd say we're probably a little bit more sanguine, if you will, on the U.S. economy than most economists out there. I think over 60% of economists are currently predicting a recession in 23.
So your base case is for below trend growth, which would be what Chairman Powell and his colleagues have said they're kind of aiming for, right? They're not aiming for that usual Goldilocks spot of between 2 and 3%. They kind of want to see it around 1 and change, right?
Correct. And we think that's, more or less essentially what we're going to get. It's not, and your point is a good one. It's definitely below trend. It's definitely much below what America's economy should be generating on a longer-term steady-state basis. Right. But given all the shocks we've had, obviously most recently the inflationary shock, which particularly is hard to deal with for small and medium-sized businesses, which is, as you know, the lifeblood of the American economy. Given all of that, a barely positive real GDP number for 23, I would consider a victory.
All right, let's pivot now and talk earnings a little bit. Just big picture perspective, right? We're not going to talk individual names here, but it's the biggest week of fourth quarter earnings season so far. Tech, of course, in the spotlight. Any thesis you have, I wonder, about what we've already seen from all of the earnings up until this point? Obviously, today we're following names like McDonald's and certainly GM, right? Beating expectations, but you could have a company like McDonald's that, or a lot of companies that may beat on top and bottom lines, but it's their forecast for the rest of 2023 in light of increasing rates, in light of inflation, that say it could be a bit troubling. So before we drill in on some of the names we'll hear from tomorrow, what do you make of what we've already seen up until today?
Sure. It won't surprise you to know I do have a thesis for earnings, and I'll share it with you. And it goes back a little bit to our conversation earlier about nominal versus real GDP growth and how much difference that makes to the earnings stream. Our expectation is that more value or cyclically oriented companies actually are positioned to do fairly well in corporate earnings this year. Again, it's sort of a counterintuitive fact, but it does hold up to historical scrutiny that in times of inflation over, let's say, 5% in the US, that actually that's a period when corporate earnings tends to be quite strong. And again, it's if you think about it, it makes some sense. In absolute terms, as inflation goes higher, generally speaking, what's generating that is economic growth, and so therefore your revenue number, comes in pretty well. So you think about, energy is not a huge part of the S&P 500, but energy companies, as we've seen from recent earnings, are basically minting money right now in this higher inflationary environment. Certain industrial and material companies probably doing the same thing. Financials, which I would also submit to you, are sort of value and cyclically oriented. Those companies now have higher interest rates, which theoretically for any bank business model should actually make their net interest margins improve. Actually a better backdrop, as long as the economy doesn't completely fall off a cliff. Banks should have a little bit better environment to earn in now that interest rates are higher. So that segment of the market, I think, is going to end up maybe doing, maybe surprising some people this year at how resilient their earnings are. Now, on the tech side, I think it's a tale of two cities. I think the boring, stodgy, mega cap tech we all know, I think they're going to continue to have really, pretty decent cash flow. But I think any segment of technology where those companies aren't earning a lot of money or frankly, any money at all, I think it's going to continue to be a pretty poisonous environment for non-profitable, non-high cash flow tech, because a rising interest rate environment is going to continue to put downward pressure on their valuation, and a 1 or 2% GDP number isn't a huge tailwind for those companies who are trying to grow.
Doesn't sound as if you're particularly bullish on the long-term prospects of the tech sector.
Again, I think it depends on which tech companies we're talking about. I am pretty bullish on the big uglies, if you will, the companies that aren't the highest growing or the sexiest, but all you have to do is look at tech companies who have instituted and grown dividends over the last 5 to 7 years. That tells me that they have the steady enough cash flow and earnings capability to be able to make that commitment to shareholders. And those companies, the valuations in 22 actually have come down a fair amount. The backdrop right now might be tough for them, but I think as long-term holds, I really like those names. But again, for companies who weren't even able to earn positive cash flow during the pandemic, when everyone was putting, was pre-spending 5 to 7 years in the future for their tech budgets, I think those companies are going to have a really hard time going forward.
10 points for use of the phrase "big uglies." By the way, I'm always taking new suggestions for what to rename the show. My producers would disagree, but I'm going to write down the phrase "big uglies" just because. Why not? I think it fits. I like it. Phrases like that are always welcome on the show. So far, is earnings season surpassing your expectations, coming up short, or somewhere in the middle?
At the margin, I think it's coming in a little bit short. But I don't think, we're only in, say, the sixth inning, so I'm going to reserve my judgment. Here's why I would say that. So we have a little bit different way of looking at a corporate earnings than maybe a bunch of other analysts do. We like to look at where the number came in relative to where the number was 6 months ago, not relative to where the estimate was 2 days ago. And the reason we like to do that is because we think companies do an exceptional job of massaging and forecasting and guiding analysts towards a place that's just, the bar is just low enough that they can jump over. But if you go back and actually look at what they were saying 6 months ago, we think that in some ways gives you a little bit better impression of how their business is actually trending. And when you look at it from that perspective, the number of beats that are happening relative to where the number was 6 months ago is, while in absolute terms it's still better than 50%, it's lower than it typically is, that beat rate. And so therefore, I would say so far, I think it's been a mildly disappointing earnings season for United States as a whole. But again, we still have a whole bunch of bellwethers that still need to report in different sectors. And so I'm going to reserve judgment until earnings season is over and the dust settles.
Absolutely. It's only the sixth inning. Is that what you said? That was your estimate? So we're not quite at the seventh inning stretch. Still a little bit before that.
I'm close to the stretch, maybe. Yeah, 6 to 7.
Close to the stretch. That's around the time up at the Bronx they play the YMCA every game as a lifelong Yankee fan. That's how I always put in perspective what song plays at Yankee Stadium. All right, let's talk the Fed here. The FOMC meeting kicks off today. In case you haven't heard, I'm kidding, of course you have. Everyone has. We'll get a decision from the central bank officials at around 2 o'clock tomorrow. Is it your view, as like 99% others think, a 25 basis point hike pretty much baked in? And what happens, dare I ask, if it's 50?
Well, the likelihood that it's 50 is pretty low. 99% is probably too low. And the reason I say that is because the Federal Reserve, in my opinion, doesn't like to surprise investors. They do, especially the modern Fed. I'm not talking about the Fed from the 70s. The modern Fed communicates more. They jawbone more. They guide more. Like I may have mentioned the word leak. I don't know if that's the right information because they don't actually leak it. But they have their sources in the press that they like to guide. And so the Fed doesn't want to surprise the market. They don't want to upset the apple cart. And so I think the number is going to come in right to where the Fed has basically guided the market that it's going to. I think it's a kind of a lead pipe cinch for 25. I could be wrong. Of course, there's always that possibility, but I do think we're going to get 25. I think more importantly is what Jay Powell says and the body language that we get from the Fed going forward, because Powell has a really, really difficult job here. Trying to walk that tightrope between slowing the economy enough to keep inflation contained, but not slowing it so much that the U.S. economy gets plunged into some sort of deep recession. Monetary policy is a blunt instrument. The Fed isn't omnipotent. And so they have a tough job, and they have to be very careful about their language. Every word matters. People like me are laser focused on every single word they say and what changed from the previous time. So that, I don't envy the Fed here. It's a tough position to be in.
It absolutely is. Now, every single time that we hear Jay Powell speak publicly, it could be a press conference, it could be an event at Brookings Institute, he always says the same thing. He says, the historical record strongly argues against prematurely loosening rates, and we will stay the course until the job is done. First, can you tell I've watched far too many of the man's speeches, as I'm sure you have, because you know that's what he says. Now, I expect Powell to reiterate inflation cannot become entrenched, that there's more to be done, et cetera. But any other commentary, you talk about the importance of body language. Will you be listening? I really hesitate to use the word pivot because we've overused it at this point, right? It's like using the word unprecedented to describe our politics. We use the word pivot a lot, but any kind of little change in commentary you'll be listening for a little bit of a different tone from Powell, seeing as the expectation is for 25, and that would start to put us into a bit of a new ball game.
Yeah, I'm so glad you referenced Powell's statements about the 1970s and 80s. I want to touch on that for a second because I think it's really important. Everyone who, folks who serve on the Federal Reserve are very astute studiers of history. You have to be. To be a quality central banker, you have to understand what came before you, understanding the mistakes that were made before, and trying to make sure you don't make the same mistakes. Powell's no different. He's incredibly intelligent and well-versed in the history of what's happened before. And if you go back to the Volcker Fed, we all, people like myself view Paul Volcker as a hero because he made very, very difficult, unpopular decisions that I think helped usher in the growth of the 80s by by sticking a stake through the heart of inflation. And it was very unpopular what he did at the time. So I think he's a hero, but I don't think we can forget that Paul Volcker also had to reverse course numerous times in the late 70s and early 80s as, lowering interest rates, and then all of a sudden inflation reared its head again. The reason I bring this up is because I know that Chairman Powell is aware, and I can tell from his statements that he's very aware of this historical precedent, and he doesn't want to fall into the same trap. He doesn't want to make some of the mistakes that the early Volcker Fed made in lowering interest rates too quickly. And that's why, even though I'm relatively sanguine on the stock market here in 23, I do think that, areas like the Treasury market are probably pricing in a little bit too much expectation that the Federal Reserve's going to start lowering rates as quickly as is being priced in, because I think the Fed is going to want to err on the side of caution and making sure they don't have to constantly flip-flop their interest rate policy like what happened in the 70s and early 80s. So I'm going to be listening.
Okay,
Your question was, what am I listening for? I'm listening for points around that specific point, referencing the 70s.
Well, it's interesting because he doesn't frequently say the name Paul Volcker, and if there's another name he doesn't say, it's certainly not Arthur Burns. But since you're clearly a fan of history like I am, let me ask you about the can I call them mistakes from the Burns era and the Nixon era in terms of monetary policy, right? Essentially raising rates aggressively, seeing where unemployment goes, dramatically U-turning, turn the entire monetary policy engine around, and then watching inflation go by and saying, oops, I never got ahead of where we were supposed to go. I wish I had done things differently. Later, quite literally, the man later in life admitting, yeah, I kind of botched up where the puck was going here. I mean, how much of a concern is that? I feel like we always talk about Paul Volcker, and understandably so, but is there not an Arthur Burns cautionary tale that is top of mind for a guy like Powell?
There's no doubt about it. Although I would submit to you, I think the biggest mistake in the Burns-led Fed wasn't so much the interest rate decisions, but rather it was allowing the credibility of the Fed and the assumed autonomy of the Fed to be called in question. That to me was a much bigger mistake than any interest rate decision that was made. Because once you start calling in question the autonomy of the Federal Reserve, you have a much bigger issue on your hands. Now you start thinking we look more like a bunch of Latin American countries I won't name, who you're never sure if the central bank is in the government's pocket or not. That to me was the biggest issue with that Fed. But to your point, absolutely, the volatility in interest rate decisions throughout that period, through two Fed governors, is top of mind for the Fed right now. They know they're going to make other mistakes, but they don't want to repeat that mistake. Is my point.
Mm-hmm. Absolutely, and you talk about pressure from the president that you face, and we know that Arthur Burns faced from his president. And at the end of the day, I'm reminded of the fact that, because I used to live in Washington, Jay Powell is a Washington, D.C. guy. And this is a guy who must be, in terms of the institutions, the power players in Washington, as acutely aware of the perception of Fed independence probably as anyone who's ever done the job. And if that means, politically speaking, making things, in theory, more difficult on the sitting president running for re-election, I can't imagine. Powell has shown nothing to demonstrate that he wouldn't be willing to do that if he thinks it's what's best in terms of policy. I always like talking history. Please come back so we could have that conversation quite literally anytime. But I do want to ask you a few broad-based questions. The 10,000-foot view here on stocks. Stocks continue to remain more or less in bear market territory. You view this as a good buying opportunity. People want to know where the dip is. Can we buy the dip? Where's the dip?
I think you can pick your spots and buy securities that you feel really good about the cash flow and yield generation ability. I think you can do that right now. And I think you should be sharpening your pencil and building your buy list of those types of securities. Writ large, I think the market is in a bit of a holding pattern, though, for the foreseeable future, not only for all the reasons we just talked about, but if you just look at the message of markets, the technical picture is pretty mixed. On the positive side, the market internals, things like the advanced decline line, and those types of indicators are much better than they were in the fall, which is heartening. And we've also, for the time being, we've been able to hold above what I consider to be psychologically important support at 4,000. We're also above the 200-day moving average. All of those are positive things. But if you take a step back and look at the 30,000-foot view, the primary trend, which I would define as the slope of the 200-day moving average, both in the United States and internationally, is still negative. And so therefore, you're still fighting the trend a little bit if you're trying to get too bullish here. I would prefer a more cautious approach and picking your spots, using excess cash to buy the types of instruments that you think can generate strong, stable yields. And this is true both in the stock and the fixed income world in the kind of economic backdrop that we have today, which I think we're going to have for quite some time.
As we're having this conversation, the S&P currently at 4039, something we're all very closely following. What are some of your tried and true investing tips that you are carrying into 2023, I wonder?
Well, you mentioned my propensity to come up with phrases. I'm going to give you another one here, one I'm very fond of. I think there's a new acronym for the type of investing environment that we're in today, and in my opinion, we're likely to be in for the foreseeable future. If the old acronym was TINA, right? Everyone talks about there was no alternative to growth stocks because interest rates were ultra low. That was the world we existed in for much of the past decade up until, let's call it, the beginning of 22. I think the new paradigm is going to be categorized by an acronym I call PATTY, P-A-T-T-Y, which is pay attention to the yield. Again, going back to the 70s, if you look at decades like the 60s and 70s, what you'll find is that a great deal of your overall total return in the stock market came from the reinvestment and compounding of dividends. Not as much from PE expansion, valuation, multiple expansion. Not quite as much as came from corporate earnings, say like in the 90s or in this decade we're just coming off of. I think the dividend yield and the coupon yield of your fixed income portfolio, I think is going to be a higher percentage of your overall return for the next 3, 5, 7 years. And so, I'm telling investors, make sure you're investing in things that you're fairly confident will continue to pay a yield and grow that yield, to have the business model and the cash flow generation ability to grow that yield over time. And some of the places we're seeing that right now, even though you'd argue that many energy companies long-term are value-destroying business models, I think energy is still in the sweet spot. I think cash flow for energy companies is going to continue to be very strong in the kind of economic environment we're predicting. And also remember that energy, just a few years ago, people were wondering if oil had any value at all. You remember that day where energy futures actually went negative for a second? Because of that, many of the less disciplined players in the oil and gas patch went out of business. They either failed or their assets got merged into bigger, better run, conglomerates. And so therefore, I think there's been some needed rationalization in the energy companies, and I continue to like those here. I also think, as we talked about earlier, that the quote unquote big ugly mega cap tech that generates cash flow and dividends, I think is still a good place to be. I think areas of healthcare, which are again cash flow generators, are a good place to be. And I think there's spots in the corporate bond market where yields have now gotten high enough that you're being compensated for some of the risks you're taking. And so there's parts of the corporate bond market we like. And look, if the 10-year treasury could get over 4% again, which we suspect will happen this year, I think treasuries 10 years starts to become very attractive to own as well. Right now we're playing, we're playing parts of the treasury curve that are have higher yields than the 10-year.
Yeah, of course, as the newly issued have, as interest rates have gone up. Finally, what are some of the most attractive sectors on Wall Street right now?
I think it's a lot of the stuff I just mentioned. I think mega cap tech, energy, healthcare, and parts of the cyclical and value end of financials, industrials. In terms of stuff that we're less excited about, I think consumer discretionary. I think the U.S. consumer is going to continue to struggle some, as the job market, as we talk about, has been really hot. It's likely to cool some further over the course of the year. Interest rates being, as high as they are on things like mortgages and car loans, I think is going to curtail, consumer spending. And I think all those things together means that, consumer discretionary, I know it's had a great early run here to start the year, but that's still an area that we're choosing to avoid. And, I think that, again, non-profitable tech, I would definitely continue to avoid non-profitable tech companies. All
right, my very special thanks to our guest today. A long conversation, but an important one And what I really appreciate, Chris Konstantinos is Chief Investment Strategist, Director of Investments at RiverFront Investment Group. I was not going to foul up your introduction or your title on the way out. Chris, thanks for being here. Great to have you.
You bet. Thanks for having me.
All right, man, we'll do it again soon. All right, folks, coming up, we will be bringing you the latest headlines on Bed Bath & Beyond as the embattled company prepares for bankruptcy. Plus, we will tell you where energy giant BP expects oil demand to go in the next decade. But first, I sat down with financial literacy expert Ross Mack to discuss how to navigate a volatile market. Take a look. A lot of people are saying, okay, hey, maybe I've now done my homework. I got a little bit of money I'm willing to invest. How do I even know the timing here? We're talking about tremendous volatility in stocks and bonds and commodities. What do you tell them with a little bit of an eye to the future, let's say over the course of the next 12, 18 months, in terms of additional homework they may do to make sure that they are entering the market at the right time?
Great question. I think we need to, once again, right, temper expectations. I think you need to come into this and say, can the market go lower? Absolutely. Can the market go higher in 5 years? Can almost say absolutely there as well. And the reason I say that is because over the long course, right, if you look at the actual statistics, the market always recovers after it goes down, right? Over the course of the 100 years or so, right, the market has an annualized, and talking about the S&P 500, it has an annualized return rate of 10%. Literally meaning you don't do anything else, you can put your money in S&P 500, and you could almost say, I'm gonna for sure make 10% each year, right? Obviously, you're looking over it over a long period of time. And so what I would say is, trying to time the market, the professionals, we look behind us. These guys are professionals and they can't time the market. And I say that in a way not to throw shade, but this is just an actual fact, right? And so timing the market is one of those things that is extremely difficult to do. Therefore, if you're a person at home, mom and pop investor, the idea is once again saying, I want to be disciplined, and I'm not trying to say I want to time the market, put $1,000 in Apple right now, and I perfectly bottomed it, and I'm gonna, make 10x in 2 years. No, the idea is saying, I want to budget and say exactly how much money I believe I can put into the market on a monthly basis or weekly, right? Or every 2 months, whatever you feel as though you could do. But the idea is being consistent. And that is what's going to make you money. So in the event you were to say you start investing today and you look up the market goes down 5% next week or next month for that matter, you're not taking your money out. No, you continue to invest because now guess what? Historically, in times of uncertainty, when the fear index is, extreme fear, those are historically been the best times to invest, right? I think we all love good shopping when it's, a holiday shopping like Black Friday, and you can get
At a discount. Yep.
Exactly. You get a TV for 30% off. Why not get an amazing company for 30, 40, 50% off as well?
All right, my special thanks there to the one and only Ross Mack, my good friend there. Okay, let's now get you caught up on some of the biggest stories that we are following for you at the street. And we'll kick things off with a look at Bed Bath & Beyond. The troubles keep mounting for that company. After failing to find a buyer, the embattled retailer will reportedly seek bankruptcy protection as soon as this week. According to Reuters, the company has lined up liquidators to shutter its stores unless a last-minute buyer comes through. Bed Bath & Beyond has been struggling, to say the least, to stay afloat for months, which has included mass losses, layoffs, executive shakeups, and a major activist investor selling his stake. Just yesterday, the major retailer said it would close 87 more stores, adding on to the 150 locations it shuttered last year. Next up, General Motors reporting fourth quarter earnings before the bell earlier today. The automaker reported better than expected results, with revenue up 28% from the same period just a year ago. GM also saw net income grow in the fourth quarter, showing a 16% jump thanks to increasing factory output. While the quarter was solid, the automaker did show signs of a margin squeeze as the company contends with a ton of headwinds. Also headlines. Looking ahead, GM is pretty optimistic, forecasting another strong year of growth for 2023. And finally, let's talk oil, folks, shall we? Energy giant BP predicting a major shift in the global energy picture, with zero carbon alternatives set to gain prominence in the coming years. According to the company's annual energy outlook report, oil and gas are expected to become a much smaller part of the mix, while renewable energies are expected to play a bit of a bigger role. BP expects that the share of fossil fuels as an energy source will slip from 80% to somewhere between 55 and 20%, while zero carbon alternatives like wind and solar energy will grow from 10% to between 35 and 65% by the year 2050. And that, my friends, is going to do it for today's edition of The Street Today. Thanks again to our special guest, Chris Konstantinos, Chief Investment Strategist, Director of Investments at RiverFront Investment Group. nailed it. Thank you to him for taking the time to join us, and stick with The Street for more on these and all of the major market stories that matter to you, and we will see you tomorrow.